You cannot trade without understanding risk on and risk off markets. Let me show you why. You wake up to see your portfolio has gone up 10% overnight. Happened to a lot of people through 2024. You celebrate it. You think you absolutely nailed it. Well done. But the next morning you wake up and it's all gone. What happened? Well, in this scenario, it's about market sentiment. Risk on versus risk off. So let's take you behind the scenes of this shift and teach you how to ride the wave instead of being wiped out. Imagine the market as a pendulum swinging between optimism and fear. On good days, the pendulum swings to risk on. This is where investors feel good about the growth opportunities. They're willing to risk more of their money. They're willing to be a little bit risky. But when fear takes over, the pendulum swings to risk off. And this is where investors look for safety. They look for slower, steady returns. So why does this matter? Well, if you can spot the swing, you're no longer reacting, you're positioning. And in trading, positioning is where the money is made. Okay, picture this. It's Monday morning and
the latest job reports just came out, and it's a blockbuster. Markets rally, people are piling into stocks, cryptocurrencies, high-yielding currencies, anywhere they possibly can because of the growth outlook.
But by Friday, the Fed,
who control the US dollar, have come in and hinted at rate hikes. Now panic sets in. Equities tumble, everyone's panicking, everyone's
rushing into gold, they're trying to find safety. That is the roller coaster of risk on, risk off. So now you know what risk on and risk off is. Let's talk about how to identify it. Now this really varies depending on the assets you trade, how you trade, and why you trade. But I'm going to give you a quick run through looking more at the economic side of things because it's where I have an area of expertise. And then we can balance that in with a couple of other areas like commodities. So first things first, let's have a look at risk on triggers. How do we identify a risk on market? A lot of it does come down to sentiment where we're in a bit of a calmer seas, so to speak. There is a stability in the market. There is predictable outcomes. There's nothing too crazy going on in the world and everyone is in a position where they're comfortable with the future outlook. That's a very generic response, but it's probably the best one you can get. If you want to look more into data orientated things like I like to do, I'm looking for things like strong GDPs in the local economy, depending on the asset you're looking at. I'm looking at things like unemployment data. I want to see that coming down, okay? And then I'm also having a look at the sentiment of central banks. So they're dovish. If they are a little bit dovish, that's obviously going to give me a little bit more stability in those assets and be more prepared to go risk on. So there's a couple data points, but mostly it's about sentiment. It's about understanding what are investors feeling. The media isn't a good track record of these sentiments. The media will always try and sell you something, sell clicks, or sell you to get you to watch something, and the best way for them to do that is through fear. So keep that in mind. If everything's doom and gloom in the media, that's just your casual Tuesday. That's nothing new. Don't read too much into that when it comes to sentiment. On the contrary, if we were to look for risk off sentiment, that's where people are fearful of the future. They're scared. There's economic turmoil. There's maybe some politics that aren't going too well, or even some wars and natural disasters happening or forecasted to happen in the very near future. A really risk off sentiment, something where you feel like you want to hold all the cash just in case you need it. That's a really good kind of gorge. You can flip side the data we previously spoke about, a weak GDP or a trending down GDP, unemployment data upticking, things like this aren't good news. That's usually more of a risk off play, and you want to be looking somewhere with a little bit more stability. Same with central banks like the Fed, the RBA, or the Bank of England. If they've got a more hawkish tone, then it probably is more advisable to have a look at something that's a little bit more risk off. That's how you kind of read into these. Now, there's not a set, this is risk on, this is risk off. You can play around with creating tools based on sentiment, but there isn't a generic tool out there that everyone uses. It is genuinely getting a feel for which direction you think you're going, and like trading, it's placing a bet on that. So how do assets react? Well, there's two columns. On the left side, we've got our risk on assets. That's going to be things like equities, cryptocurrencies, anything that you think carries an inherent risk. Look into emerging market assets. Have a look into high yield corporate bonds. All of this is a risk on asset. To the contrary, if we were to flip the page and have a look at risk off assets, we're going to be looking at things like stable currencies, bonds, gold, the Japanese yen, really those established markets, defensive stocks. Yes, defense stocks, but also defensive stocks like utilities. And the most important one, cash. A lot of people just hold cash when it's a risk-off market. So now let's do an activity. You know what risk-on and risk-off assets are. You know what a risk-on and risk-off market is. But how do you identify it? We've touched on it briefly on how I do it, but now I'm going to build you a dashboard. We're going to do an activity and we're going to pretend you are the driver. I'm going to give you 3 things that you can have a look at to try and depict whether or not we are risk on or risk off. The first one we're going to look into is the VIX. If you haven't heard of the VIX, it's the volatility index of the S&P 500. This is the undisclosed fear index of volatility. If this is rising, it means risk off. The second thing are bond yields. The longer term yields, the more severe the case. If bond yields are falling, risk off. If bond yields are rising, risk on. And then the last tool is currency strength. Now this is a little bit more nuanced. As a currency trader myself, it's a little bit harder to use these as sentiment because they're the assets that I actually trade. And I understand that there's a lot more that pulls into a value of a currency than just market sentiment. However, the correlation here I want you to identify is when both the US dollar and the Japanese yen are rising. The both of them collectively. That's usually a sign of a risk-off market. Here's some real-life examples for you. During the 2008 financial crisis, bond yields dropped sharply while the VIX spiked. Investors then piled into US treasuries and gold. But on the contrary, if you have a look at the 2021 reopening, yields rose, the VIX calmed, and risk on assets like tech stocks thrived. Therefore, these tools have a track record of working. Now, take all this with caution because I've made mistakes and I want you to learn from them. I'm going to give you a couple of my mistakes that have really burned me, so hopefully you don't have to go through them. So lesson number 1 is always watch the bigger picture. Short-term news can outweigh long-term sentiment for a near short term. Don't fall into the FOMO trap of a market shift sentiment if it doesn't relate to the bigger picture. Secondly, don't chase moves after sentiment shifts are obvious. You're too late. The move's gone, look for another. And lastly, and most importantly, please avoid overexposure. If you think you've found an opportunity to position yourself for a market shift, awesome. Don't go all in. Don't overexpose yourself to a simple trade idea. Market tells a story every day, and risk on, risk off is a story you have to follow. You know the steps. Understand the triggers, use the tools, and position yourself wisely. If you enjoyed the video, I'm glad. If you got some value from it, let me know in the comments what you enjoyed, or if you have any further questions and we'll continue the conversation. Market Wake Up is here to help you break down the macro and understand investing and trading in a much more simple manner. Thank you for watching, and we'll see you next time.